Ever felt that painful moment when price hits your stop loss perfectly and then takes off in the direction you expected? That's not bad luck. That's liquidity. And if you've ever wondered why this happens again and again, this is the video you've been waiting for. Welcome to LutaMarkets, where we go beyond simple chart patterns and indicators and dive deep into institutional logic. Here, we uncover how smart money truly moves the market and how you can learn to trade alongside it, not against it. If you want to understand how liquidity shapes every candle and every move, hit that subscribe button right now, because this series will change how you see the markets forever. Let's be honest, most traders don't lose because of bad setups. They lose because they don't understand liquidity. They enter at the wrong place, exit too early, or get stopped out right before price runs. Why? Because institutions use liquidity to collect orders, and if you don't know where that liquidity lives, you'll always be on the wrong side of the move. But not anymore. In this video, the first episode of our Liquidity Logic Series, we're going to lay the foundation. We'll start by answering the question, what exactly is liquidity? Then I'll introduce the 5 powerful liquidity logics we'll cover in this entire series, and we'll dive deeply into the first one today, order flow intention logic. Let's start simple. Liquidity means availability of orders, the ease with which price can move because there are enough buyers and sellers in the market. In other words, liquidity is the fuel that moves price. When there are many traders buying and selling, price can move smoothly. But institutions, or what we call smart money, need massive amounts of liquidity to fill their positions. They can't just buy or sell anywhere. So what do? They go hunting. They look for areas where retail traders' stop losses are sitting, because those stops represent ready-made liquidity. When your stop gets hit, your broker executes a market order, and that's exactly what institutions use to fill their large trades. That's the game. And once you understand it, you stop being the hunted and start trading with the hunters. Now, to truly master liquidity, I've divided this concept into 5 logical frameworks, 5 lenses through which we can see exactly where institutions operate. These are the 5 liquidity logics we'll explore in this series. Order flow intention logic, where liquidity exists based on how retail traders place their stop losses. Volume and wick logic, how sudden spikes in volume or long wicks expose liquidity sweeps. High volume node logic, where price historically traded heavily, showing institutional footprints. Range-bound liquidity logic, liquidity that builds above and below consolidation zones. Session liquidity logic, how London and New York sessions trigger liquidity hunts with precision timing. In this first episode, we're starting with Logic 1, order flow intention, the foundation of understanding how liquidity actually forms. So, what does order flow intention really mean? It's about understanding why price moves, not just where. Institutions don't chase random levels. They target areas where the crowd has placed stop losses. Think of it this way. Liquidity equals where smart money expects retail stops to be. Whenever the market forms something too obvious, like a double top, double bottom, or a clean trend line, retail traders pile in. They see safety in structure, but institutions see opportunity. If the structure is too clean, that's a red flag, because smart money knows most traders are hiding their stops just beyond those highs or lows. Here's the simple logic. If price forms a clear retail structure and that structure becomes too obvious, then mark the area just beyond that structure as the liquidity zone. Example: if everyone sees a double top, Institutions see buy-side liquidity above it. If everyone sees a double bottom, they see sell-side liquidity below it. Price pushes beyond those highs or lows just enough to trigger stops, and then reverses sharply. That reversal isn't magic. It's a liquidity grab. Institutions just collected enough orders to fill their big positions. So next time you see price taking out a clean high or low and rejecting instantly, remember, you're witnessing an order flow intention play out in real time. Before you mark any zone, ask yourself, if I were an institution and I needed liquidity, where would I go to find it? Once you train your mind to think this way, your chart stops looking random. Every move starts to make sense. If this episode helped you understand what liquidity truly is and how order flow intention logic reveals institutional moves, make sure to hit like, subscribe, and comment Liquidity Logic below so you don't miss the next lessons. In Episode 2, we'll explore volume and wick logic, how sharp volume spikes and long wicks confirm institutional liquidity hunts in real time. This is just the beginning. We're building your full understanding of liquidity, manipulation, and precision trading one logic at a time. Stay tuned and trade smart with LutaMarkets.